Silver is trading at 76.34 this morning, and that number is doing a lot of work to hide what is actually happening underneath it. The screen price tells you one thing. Curious, the physical market in Shanghai tells you something else entirely. And by the time you finish watching this, you'll understand why those two numbers have diverged to a degree that simply cannot hold without something giving way. Here's what the mainstream red says. Silver is down. The Iran war is pushing oil higher. A stronger dollar is weighing on metals. The Federal Reserve held rates steady last night. Normal market forces move along. That explanation is not wrong. It is just radically incomplete. Because while the paper price on the COMEX, the commodity exchange in New York, where most silver futures are traded and where the benchmark price is set, sits at 76.34, buyers in Shanghai at the Shanghai Gold Exchange, the world's primary physical settlement platform for silver, have been paying materially, structurally, and persistently more than that. Not a few cents. Not a rounding error. We are talking about a premium that at its peak this cycle has exceeded $8 per ounce, and that has not disappeared. It has compressed and re-expanded in a pattern that analysts who track physical flows have never seen sustained at this level before. Here's the math that should stop you. The COMEX's own vault data, updated daily, shows that registered silver, the only silver that actually counts for delivery purposes against futures contracts, has declined 15.1% in the past 30 days alone. That is 14 million ounces withdrawn from the deliverable pool in a single month. The coverage ratio, meaning the percentage of outstanding paper claims that could theoretically be met with real deliverable metal, currently stands at 13.7%. That is stress territory by the exchange's own classifications. Paper leverage sits at 7.3 times. That means for every ounce of silver that can actually be handed over, there are 7.3 ounces of paper claims on it. And April 1st notice day, the point at which futures contracts must either roll or stand for delivery, is 9 business days away, with 1,903 contracts still open, representing 9.5 million ounces of potential physical demand. You will not see those numbers connected together on Bloomberg this morning, but they will be connected. By the end of this video, you will understand exactly how, and you will have 3 specific time-bound things you can verify yourself in the next 48 to 72 hours to watch how this resolves. The Federal Reserve, the United States central bank that sets the benchmark interest rate affecting every dollar-denominated asset on Earth, held its policy rate at 3.5% to 3.75% last night by an 11-to-1 vote. The lone dissenter, Governor Stephen Moran, wanted a cut. Everyone else voted to hold. In the updated Summary of Economic Projections, the document known as the dot plot, where all 19 committee members publish their rate forecasts, the median now points to 1 cut this year and 1 in 2027. But here is what that statement conceals. 7 members now believe rates should not move at all in 2026, up from 6 in December. 1 more hawkish vote on a committee that already holds the rate at 40-year high territory relative to recent history, and the Fed simultaneously raised its 2026 PCE inflation forecast, the measure of inflation it formally targets, to 2.7% from 2.5%. Core inflation, excluding food and energy, also revised to 2.7%. For silver, this creates a specific tension that requires unpacking. A stronger dollar and higher rates are conventionally bad for metals because they compete with yield-bearing assets. The dollar index, the DXY, which measures the greenback against a basket of major currencies, topped 100 after Powell's press conference. That is the conventional downward pressure the mainstream narrative identifies. But underneath that currency effect, something else is happening that the rate discussion completely obscures. Producer prices in February, reported Tuesday by the Bureau of Labor Statistics, surged 0.7% month on month, more than double the 0.3% consensus estimate. Core PPI rose 0.5%, also double expectations. Year-over-year PPI is running at 3.4%, the hottest since February 2025. And critically, as analysts at CNBC noted, none of this data yet captures the price increases from the U.S.-Israel strikes on Iran, which began in late February. Oil has surged approximately 70% year-to-date to around $100 per barrel. That inflation is coming. The February data is already a historical relic. What this means for silver specifically, the inflation that is already running in industrial inputs, the energy that runs the mines, the transportation that moves the metal, the energy embedded in refining, is structural. Silver mine production costs are rising even as the paper price in New York comes under pressure from a strengthened dollar. That gap between what it costs to produce an ounce of silver and what the COMEX screen says it is worth is being measured and acted upon every single day by industrial users in China, India, and across Asia. They are not buying the paper, they are buying the metal itself. The Shanghai Gold Exchange, China's primary physical precious metals exchange, where contracts are settled almost entirely in real metal, has been registering a persistent, documented premium over the COMEX benchmark throughout this cycle. At its peak in late December 2025, that premium exceeded $8 per ounce, according to data published by the exchange and widely tracked by analysts monitoring the SGE's Age T+D contract. The Shanghai Futures Exchange, separately, has seen silver trade above $82 per ounce during periods this cycle, well above Western paper benchmarks at the same moments. Those premiums are not tax effects. China does impose a 13% value-added tax on silver imports, which accounts for a structural portion of any premium. But the premiums we are seeing, verified by multiple tracking sources, go beyond what VAT alone explains. They reflect genuine physical tightness. Industrial users in China, who consume silver for solar panel manufacture, electric vehicle components, and electronics at a scale that dwarfs any other nation's consumption, are competing for real bars, and they are paying up for them. Here's what most analysis missed entirely. The Shanghai Gold Exchange's own inventory data, published publicly and tracked by researchers, hit 10.24 million ounces on February 9, 2026, the lowest level since 2015. That is not speculation. That is the exchange's own reported figure. When an exchange's physical inventory drops to an 11-year low while the global paper price sits at $76, you are looking at a market that is fractured along the seam between what paper says silver is worth and what the people who actually need silver physically are paying for it. Now here's the mechanism that changes everything, and why this moment is different from the noise that comes and goes. The COMEX, the exchange operated by CME Group in New York, which sets the global benchmark silver price through futures trading, completed its March 2026 delivery cycle with 10,526 contracts standing for physical delivery. That is 52.63 million ounces demanded as real metal against 86.13 million ounces of registered inventory. Those numbers sound manageable on paper, but they come directly after February 2026 delivered 5,036 contracts, 25.18 million ounces, which was the highest February delivery volume in modern COMEX history. Before 2026, January deliveries in any year typically ran between 1 and 5 million ounces. January 2026 alone saw 33.45 million ounces delivered in 7 days, representing roughly 26% of the entire registered inventory disappearing in a single week. The people taking delivery are not retail investors. They are industrial users and institutions who have decided explicitly that holding a paper promise is no longer sufficient. They want the bars. This is the mechanism that changes today's price from a number into a signal. The COMEX does not manufacture silver. It warehouses it and settles claims against it. Every time physical metal leaves those vaults in response to a delivery notice, it does not come back unless someone deposits new metal. And the withdrawal pace, 14 million ounces in the last 30 days alone, at the current rate, projects the registered pool to exhaustion in approximately 107 trading days, which is roughly 5 calendar months. That is not a prediction. That is the arithmetic of the current trend run straight. The historical parallel that makes this readable is not the Hunt brothers' silver squeeze of 1980, though the surface resemblance is obvious. The closer structural parallel is the London Metal Exchange nickel halt of March 2022. On March 8th of that year, nickel prices doubled in hours on the LME, the London Metal Exchange, the world's primary nickel futures venue, as a short squeeze collided with an exchange that had insufficient physical metal to backstop the paper system. The LME suspended trading. Contracts were canceled. Short sellers who had been suppressing the price through paper positions were temporarily protected by the exchange itself. The price on screen did not reflect what nickel was actually worth in the physical market. It reflected what the exchange's administrative intervention decided it should be. The key difference between 2022 nickel and 2026 silver is scale and duration. The nickel squeeze developed in weeks. The silver supply drain has been visible in public exchange data for months. COMEX registered inventory has declined 64.1% from its April 2020 peak of 240 million ounces to 86.13 million in February. Shanghai's combined SGE and SHFE inventories have fallen 43% since November 2025. The depletion is not a sudden shock. It is a slow drain, which means the institutions watching it have had time to position accordingly. The question is not whether they have noticed. The question is which side of that positioning you are on when the arithmetic forces a resolution. The paper price you can print endlessly. You cannot print the metal itself. Now here is where the counter-argument lives, and it deserves to be stated clearly and fairly. The skeptical case, the legitimate bearish read, goes as follows. COMEX has functioning delivery mechanics that have operated without a structural default for decades. Most futures contracts never result in physical delivery. They roll forward or settle in cash. The 7.3 times paper leverage figure sounds alarming, but it exists in every functioning futures market in the world, including oil and agricultural commodities, and defaults are rare. The conversion pipeline from eligible to registered silver can add deliverable supply in 24 to 48 hours, And critically, the price has already corrected dramatically. Silver hit 121.67 on January 29, 2026, its all-time nominal high, and has since retreated to 76.34, a decline of more than 37%. The overheated speculative positioning has been flushed. The pain has been taken. Markets clear. This is not a straw man. These are real mechanisms that have prevented defaults throughout modern commodity market history, including in far more stressed environments. And markets can do things that defy the structural data. That is not a disclaimer. It is a fact that any honest analyst must acknowledge. But here is what the counter-argument does not account for. The delivery demand this cycle has not come from retail speculators. The COMEX's own data shows that speculative managed money positioning collapsed 77.72% year over year, from 54,415 contracts in February 2025 to 12,121 contracts in February 2026. The people who stood for delivery of 52.63 million ounces in March 2026, while speculative positioning hit multi-year lows, were not momentum traders. They were industrial users and institutions who decided, with reduced speculative noise in the market, to take the metal. That is a different kind of demand. It does not roll forward. It does not close the position and walk away. It demands the bars, and the bars are leaving. The iShares Silver Trust, known as SLV, has seen net capital outflows of approximately $1.18 billion, even as prices oscillated at elevated levels. Global silver ETF holdings sit at 817.53 million ounces, down roughly 5.3% year to date. This is the conventional bearish signal that institutional money is exiting the paper silver trade. But here's the question nobody in the mainstream commentary is asking: where is that metal going? ETF outflows mean silver bars are being redeemed from custody. Those bars do not evaporate. They go somewhere. The data on where they are going points east, and the premium in Shanghai suggests they are being absorbed immediately upon arrival. Here are 3 specific things to watch over the next 48 to 72 hours. The first is tonight's CME Group Vault Report, published daily at approximately 4 p.m. Eastern. Watch the registered inventory number. Anything below 78 million ounces would mark the lowest level since November 2023 and would mean the 107-day exhaustion projection shortens materially. If it drops and eligible does not convert to compensate, that is a supply structure tightening further, even as the paper price sits under pressure. The second is the April 2026 First Notice Day Open Interest Countdown. With 9 business days remaining and 1,903 contracts still open, watch for any acceleration in the rollout or stand for delivery decision. The CME Group's own daily delivery notice report, available publicly at cmegroup.com, will show you the first notices as they are issued. A daily delivery number above 300 contracts before First Notice Day arrives would be anomalous by historical standards and would suggest the physical demand pattern from March is repeating into April. The third is the Shanghai premium. If the SGE AG T+D contract, the physical delivery contract in Shanghai, widens back above $5 per ounce versus COMEX as the DXY holds above 100, you are watching the East discount the paper price in New York in real time. That premium narrowing would be the bullish signal fading. Widening above $5 would be the physical market reasserting that the screen price is fiction. What ties these 3 together into one picture? The Fed held rates last night and signaled that cuts are not coming soon. That means the dollar stays firm in the near term, which puts conventional downward pressure on the paper silver price in New York. But that same rate hold, in the context of 3.4% producer price inflation and oil at $100 per barrel, means that the real cost of producing the next ounce of silver out of the ground is rising. The cost to mine, refine, transport, and insure a silver bar is going up in exactly the environment where the paper price has retreated. The gap between production cost and screen price is exactly the kind of structural tension that does not resolve quietly. What this moment actually reveals, and what was never stated explicitly in everything you just heard, is that the global silver market is running 2 prices simultaneously. One price is visible on every financial terminal, quoted in real time, referenced by the Fed and by Bloomberg and by every ETF prospectus, the COMEX paper benchmark. The other price is being discovered in Shanghai, in Mumbai, in every private transaction where someone needs silver bars physically in their vault before the end of the quarter. Those 2 prices diverged dramatically during 2025. They compressed when the paper price rallied to $121 in January. They diverged again as the paper price fell back. What the data from the vault reports, the delivery notices, the Shanghai premiums, and the LBMA lease rate, which briefly hit 6% in early February before easing to 0.9% now, is collectively telling you is that the convergence, when it comes, will be driven by the physical market pulling the paper price up, not by speculators pushing the screen higher. The COMEX silver price at $76.34 today is the price of a financial contract. The price of actual silver bars delivered in Shanghai is something else. Those 2 prices cannot coexist indefinitely. One of them has to be wrong. Given that registered COMEX inventory has now declined 15.1% in the past 30 days, that the coverage ratio stands at 13.7%, and that April 1st notice day arrives in 9 business days with 1,903 contracts undecided, where do you think the registered inventory number sits when first notice day prints? Give me your number in the comments. If you model it differently than I do, I want to see your math. I'll pin the most rigorous analysis in the thread. April 1st notice day falls in 9 business days. I'll have the delivery notice analysis up the same evening the numbers drop from CME Group. Subscribe with notifications on if you want to see it before the market opens the following morning. This is a market where the 12-hour window matters. Everything in this video is sourced from publicly available data. CME Group daily vault reports, COMEX delivery notice publications, USA Gold price history, trading economics, APMEX price data, CBS News, CNBC, NPR, FX's Street, and Business Standard. The links will be in the description. I am not a financial advisor and nothing here is investment advice. Every number I cited is checkable tonight. Check them. Make your own decisions with your own capital. The data belongs to everyone. What you do with it is your responsibility.